Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. I appreciate so much you spending a few minutes with me here as we do a little bit of a review, recap of the first calendar quarter of 2025. I know, ready or not, we've already got 1 out of 4 behind us. And also take a look at what the balance of the year looks like in the overall economy, certainly the markets as well. So I respect your time here. I want to get right into it. Let's go ahead and do a brief recap on what we saw in the first quarter of this year, a real turnaround. And we talked about this a lot in some of our previous updates here in talking about what was happening in the markets, the narrow nature of it, meaning that it was a relatively small handful of stocks. And I'm talking equity markets that were doing very, very well. Specifically, I'm looking at things like large technology companies and even some smaller ones as well, which were doing exceptionally well. And that was really masking some, let's call it, less than desirable to maybe even completely mediocre sort of returns in significant other parts of the market. But if you looked at just the most popular stock indices, I'm looking at Dow Jones Industrial Average, S&P 500 Index, or the NASDAQ Composite, especially towards the end of last year, all of those returns look superlative. Now here in the first quarter of this year, we've had almost a complete reversal of the sectors that are leading the market in terms of positive performance. But also what's happened is, because those large technology companies, information services, consumer discretionary kinds of things are so large, they're actually showing notable returns in our stock market indices, even though several sectors are doing very, very well. Let me highlight the point. If you take a look at Dow Jones Industrial Average, S&P 500 Index, and the NASDAQ Composite here for the first quarter, you're going to see returns anywhere from flat to down about 10% in one quarter. Some of the worst returns in a single quarter that we've seen since 2022, so for the last couple of years. Pretty notable. So when you're looking at that, you may think that the overall market has just been miserable, and in some parts, some pretty notable parts, you'd be correct. However, if you peel some of the layers back on the proverbial onion, you're going to find that there are several other parts of the market which happen to be doing very well. They happen to be parts of the market which have been largely ignored here for the last couple of years. I'm looking at things like utilities. I'm looking at things like pharmaceuticals. I'm looking at things like oil and energy companies, which have done quite well here to start the year. But again, some of those companies are quite a bit smaller than some of these mega cap technology companies. And so they haven't had as much influence in producing positive returns in our stock market indices. I'm saying all of that, yes, A, to give you a recap on where things are, but also B, to provide some perspective, again, on where we are as a market. If you're watching any of the same business news programs that I do on a pretty consistent basis, you would think that the whole world economy is coming to a grinding halt. Folks, it's just not true. We have some significant issues. I'll talk about that in a few minutes, especially with regards to some of the buzzwords that are definitely hitting all of our news headlines here and about some of the things we need to keep in mind as we're working our way through this time. But it's not true that every part of the market or every part of the economy is doing terrible right now. It just isn't. And you don't have to believe me. Take a look at the numbers themselves that I've highlighted here and certainly other due diligence as well. But when we're looking at what that means market-wise for what we can expect for the balance of the year, I expect it's going to be turbulent. Why do we expect that? Well, because we got some pretty significant headlines that the market is having a difficult time overall digesting and then more specifically quantifying in terms of feeling confident about moving forward with positive market performance. That's just a 10-cent phrase and a 10-cent sentence to highlight what I'm going to say next. This word, you've heard it a lot. We didn't hear it a whole lot until here over the last 6 months or so, at least not in most conversational circles, but we've certainly heard the word tariffs a lot here in the last 6 months. Now, tariffs, generally speaking, real quick, Econ 101, generally speaking, tariffs are a tax or a fee on goods coming into a certain country. In this case, I'm talking about the United States. What that's intended to do by making things that are imported into the country more expensive are to make domestic products more competitive, perhaps even cheaper, and to incentivize the buyers then to buy those cheaper domestically made products. Now, as you've heard me say countless times previously, when it comes to macroeconomic issues, nothing is binary. It's not true that if we just have one stimulus, we're just going to have one result. Nothing in our $30 trillion economy is going to work that way. So we're seeing some of the parts of the market attempting to quantify, well, what are tariffs going to actually mean? We certainly hear the percentages. 10% here, 15% there, 25% there on certain countries, on certain products, on certain sectors or industries. But the market is having a difficult time quantifying that, not because it doesn't understand those percentages, but perhaps more importantly, what's going to be the duration. Because the numbers and the intensity of those tariff negotiations has varied greatly here over the last several weeks. So we really don't know at this point how long are they going to last, on what specific products are they going to which they're going to be related. Are there going to be any exceptions at any point along the way? Will this bring folks to the negotiating table to try to find some level of compromise? None of that we know yet. And when the market has that level of uncertainty, you get the kind of performance that we're seeing in terms of especially our more aggressive holdings in the markets that we've seen here over the last several weeks. Now, if you're looking at some of those more aggressive holdings, you've seen quite a bit of negative volatility. Not all of them, not all companies, but again, looking at those larger technology companies, which have done so incredibly well here over the last couple of years, that tends to be where we have seen the largest pullbacks. And in some cases, 20, 30, 40%, even more off of the highs. Folks, that's natural. When we're talking about more aggressive holdings in the market, we expect that when something is climbing exponentially, that there are times when it's going to decline exponentially as well. It's a very common kind of occurrence. That isn't something that's strange or unusual or we've never been here previously. This is a very expected kind of movement. Also very interesting, reverting to a previous point in my discussion with you here, are the sectors that are doing quite well year to date. I'll remind you, oil and energy, pharmaceuticals, utilities, all sector-wise, not all of the companies in those sectors, but sector-wise, notably positive here in the first quarter. So when the economy is trying to quantify all of this, and specifically the markets, that's what they do, trying to quantify all of this, and then looking forward here over the next quarter, over the next couple of quarters for the balance of the year, what can we anticipate? Well, as I mentioned here a few moments ago, I'm going to give you a terrible answer. Nobody knows, of course. Nobody ever knows in advance. But what we do know is that this kind of movement, as we've discussed some previously, this kind of movement, regardless of the reason for it, was needed and expected. We were running so incredibly above the wire for a long period of time, certainly from a stock market index standpoint, that we knew we had to run under the wire, or the average, if you will, for some measure of time in order to create, I know, wait for it, the average. That's how those things go together. And that's a little bit of what we're experiencing right now. So this is a very natural and even expected kind of occurrence. Now, the very natural question is, okay, so we expected it. How long is it going to last? It's going to last for some measure of time yet. I'm not saying that there isn't going to be positive movement in the markets, but the markets need to get resituated with these new fiscal and monetary policies, both from the Federal Reserve and from our legislative bodies, about what this is going to mean in terms of economic growth, certainly in an ongoing kind of way. It's going to be determined in some measure by how long these tariffs last, meaning what ancillary effects are they going to have in other parts of the economy? But there are other dominoes that are going to be falling as well. You've heard me talk about this large basket of tax breaks that's still sitting out there set to sunset at the end of this calendar year. That's high on Congress's radar screen as well. Which of those tax breaks are going to be extended? Which are going to be made, perhaps even made permanent? What are ones that are going to be allowed to sunset altogether? That's also going to have a significant effect on the consumer. Speaking of the consumer, as you heard me say in one of my more recent updates here, the consumer is starting to slow down a little bit. Not wholesale or not that they've stopped spending, just not, again, spending at some of these superlative levels that we have seen for a significant period of time. We've seen that in some of the quarterly earnings reports from some of our largest retailers. I'm looking at Kohl's, at Target, at Walmart, giving some indication that going forward, even though we had a pretty robust Christmas retail season, that going forward they don't expect the consumer to continue to spend at the same levels that they have spent to this point. That's notable. Remember, the consumer is approximately 2/3 to 3/4 of our overall economy, or GDP. Basically, as the consumer spends, so does our economy go, relatively speaking, being a little bit oversimplistic when I say that. So when we're hearing about the consumer slowing down a little bit, that might mean that we're slowing down a little bit also as a macro economy. Again, not wanting to raise unnatural concern. We're not seeing other macro factors in there that would suggest that things are moving towards a proverbial cliff. It's just the kind of thing that we're watching and that we're keeping in mind, especially as we're looking at anticipated market performance, both positive and negative, here for the balance of the year. So as you heard me say in my previous update, I'm fairly reserved in my expectations for the balance of this year. One, because we've had two superlative years back to back as far as market index performance is concerned. And then two, some of the factors that we're talking about here, where there's just a notable amount of uncertainty and pricing about what the economic impact is going to be of the current tracks that we're on. So that's what we're anticipating at this point. Obviously, those things can change very, very quickly, and we're going to be watching them through the course of this year. Well, friends, I appreciate so much your time. Thank you for spending a few minutes with me here to hear our thoughts about where we think things are. You know, at any time, if you'd like to reach out and chat about your portfolio, the overall economy, perhaps what the things that are bubbling through Washington, D.C. at any given time, there's always plenty to talk about on those ends of things. Always happy to chat with you either electronically or in person, as is good for you, and happy to move and make tweaks if it's appropriate for your particular situation. Also enjoy hearing about how your spring seasons are starting out. We're starting to thaw out a little bit in parts of the country. Boy, if you're out the far west there in Utah and Colorado, you're still getting a very heavy dose of winter on your end of things, and also in the upper Midwest as well. So what I'm talking about here doesn't have a whole lot of relevance for you, but in other parts of the country, we're starting to thaw out a little bit. We're starting to see flowers bloom in some of our warmer areas. That's always good to see. Also seeing some exciting things like baseball season, if you're into baseball season, although our Pittsburgh Pirates have started out a little, let's say, less than desired in terms of starting this season here, but perhaps things will turn around. Also, I've talked with a couple of you who've said I need to mention hockey as well. Always watching hockey and our local hockey teams, and so they're going to be getting into playoff season here before too long. On that end of things as well. Always enjoyable to watch that. And then somebody told me we're probably going to get ready here for the football draft before too long as well. Certainly that'll be in the mix of things also. Well, friends, I appreciate so much you spending this time here with me. I hope that you're doing well. Please always feel free to reach out at any time. And until that next time, I'll look forward to chatting with you soon.